Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute. It's March 10th, 2013. Stocks roared ahead last week, up over 2%, while surfing the big wave that came on the day of its biggest gains, the day of breaking the all-time record on the Dow Jones Industrial Average, although not a record when adjusted for inflation. It seemed to convince traders, both human and non, that there is nothing to fear, especially with two central bank meetings coming up. If anything goes wrong, they'll just fix it, won't they? The European Central Bank did not lower rates, as some had hoped and as I had speculated. But how could President Mario Draghi have done so, with the Italian stock index, for example, already up 2% on the week by the time of the meeting? Indeed, it finished up over 3% on the week. The bank did lower its outlook for this year and for next year, and the latest data out of Germany was not good. But with stock markets soaring, why bother pulling out a rate cut now? Even though the EU economy may justify it, the effects on the asset markets would have been too much. Stock prices aren't going to be able to support this kind of nonstop climb for much longer. The global economy just isn't that good. But equities aren't about to go down yet. After all, there's another Fed meeting this month. Could there be anything more bullish for stocks than another Fed meeting? In 2007, stocks rallied all year on the hopes of a rate cut that never came. And when it did come, it didn't really do any good. Now we rally on the hopes that the Fed will never stop buying $85 billion of bonds every month. It's a real sign of economic health, isn't it? Then there was the jobs report. It was interesting being a virtual replica of February 2012. What's more, I did a look under the hood at the numbers, and I'm sorry to say that it didn't hold up so well. Nearly 50,000 of the total came from retailers not laying off as many people in February. That's right, retailers didn't actually add any jobs, despite what you might have read in the papers. In the real world, retail jobs get cut at this time of year. What happened is that retailers hired about 50,000 fewer people in December 2012 than December 2011. Afterwards, laid off 50,000 less. That translated into a 50,000 net add from February 2012 to February 2013. I don't buy that kind of arithmetic. I'm also suspicious of the huge spike in movie industry jobs. We'll see how that one turns out. The drop in the unemployment rate due mainly to people dropping out of the labor force. The participation rate fell significantly from a year ago. Honeywell CEO Dave Cote last week told the Wall Street Journal that the giant company is only replacing 2 or 3 workers out of every 5 they let go. Yet the Saturday headline in the Wall Street Journal was, "Employers ignore economic clouds." It might just as well have said, "Buy stocks, you fools, before it's too late." Well, let me give you a bit of reality. So far this year, the real change in the job force for the first 2 months is smaller than it was in 2012. But do believe that the stock market still wants to go higher, and it will too, unless something comes along out of the Middle East or Europe or someplace to remind us that not all is for the best in the best of all worlds. We might get a bump along the way, but the first quarter this year is trying its best to copy the first quarter of last year. So far, we're up nearly 9%, leaving us 2 or 3% to go. Just remember that it can leave a lot faster than it came. I'm Kevin Flynn, and thank you for listening to Avalon's Market Minute.